Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 companies who are soon to be Dividend Kings. A Dividend King is the impressive company who's been paying out a growing dividend for over 50 consecutive years. That means through any economic hardship, the company has not only paid out their dividend, but they continue to grow it year in and year out. These are some of the most stable businesses on the market that are able to generate cash flow through any economic period, which is absolutely impressive. So in this episode, we're going to take a look at 3 companies who are not yet Dividend Kings, but I believe will achieve the feat very soon. So for each of the 3 stocks we're going to go over, we're going to take a look at an overview of their current operations, go over their financials, and of course evaluate their dividend at this current point in time. But before we jump into stock number 1, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over anything dividend related, and of course we track the progress of my own portfolio, which now sits at a value of $166,000. So if you're interested in investing content, please hit that like button and subscribe down below. And now we're going to jump straight into the first future Dividend King, and that is ticker MDT for Medtronic. This is a medical device company that currently trades for $83 per share. They have a market cap at $105 billion with a current dividend yield of 3.32% and a very reasonable forward PE ratio of only 14.8. We can see over the past year, the company has seen a major decline with the overall market, down 30% on the 12-month chart, and they have now fallen to very close to the bottom on the 52-week range. And at this current share price, the company is actually considered to be undervalued according to Morningstar. Per the Morningstar report, their estimated fair value per share is sitting at $102, meaning Medtronic is now sitting with a 23% discount at this current share price. So this company is soon to be a Dividend King, and they're trading at a significant discount at this current point in time. And if we take a look at their latest investor presentation, the company is spread out all around the world. They have over 95,000 employees. They continue to invest back into their business. And in 2022, they invested $2.7 billion into research and development, and they generated over $31 billion in revenue over the past fiscal year as well. And the company mainly services 4 areas of healthcare, which include medical surgery, diabetes, neuroscience, and cardiovascular health. And the company overall has done a great job of focusing on the future. With a lot of medical device companies, once they have an established portfolio, if they stop focusing on future growth and future developments, that's when the companies slowly start to die down. And why I believe Medtronic has been able to achieve such a long streak of strong financial performance is because the company's management and executives have a strong focus on the future and prioritize investments into research and future pipeline projects. Over fiscal year 2022, they saw a 10% increase in R&D funding. They invested over $3.3 billion in mergers and acquisitions in the past 2 years, and they've invested over $850 million as of Q1 of fiscal year 2023 into over 75 smaller companies that all may make a nice addition to the Medtronic portfolio. So overall, the companies continue to grow so well over the long term because management is not complacent. They continue to focus and innovate and want to create the best products on the market. Medtronic's management also has done an incredible job of returning a ton of value to the shareholder. That's why this company is included in this video. They target a minimum of 50% of their free cash flow be returned to the shareholders every single year. And in the past fiscal year, they returned $5.5 billion in the form of share buybacks and dividends, representing 92% of their total free cash flow. So the company does have a strong value in returning equity to the shareholders in every way. They've also done an incredible job of growing their dividend, and that's why they're included to be a future Dividend King, because they currently have a 45-year streak of dividend increases. 45 years straight through every economic hardship we've gone through during the past 45 years. Not only have they continued to pay their dividend, but they've also announced an increase each and every year, which is incredibly impressive. They're committed to grow the dividend in line with their earnings over the long term, and over the past year, they raised their dividend by 8%. And overall, they are targeting a lot of share buybacks as well, like we can see, with $2.5 billion of shares purchased over the past year. And taking a look at a long-term trend of share buybacks, we can see they've done a great job of eating their outstanding share count, decreasing it by over 100 million shares in the past few years. And overall, the company believes over the longer term, they can grow organic revenue by 5+%, increase their margins every single year, have over 8% adjusted EBITDA growth, free cash flow conversion of over 80%, continue to grow that dividend over the long term, and they do believe that through share buybacks, their dividend, and capital appreciation, they can return an annual return to shareholders of over 10%, which is incredible and exactly what we want to see as investors in the market. And if we take a look at their balance sheet, they are in a very strong financial position. The company has total current assets of around $22 billion with total short-term liabilities of only $14 billion, so a current ratio safely above 1 and no risk of short-term financial hardship for Medtronic at this current point in time. And something I like to see is for a company with such a strong current ratio, their long-term debt has been taken down significantly over the past few years. At year-end April 2021, they had $26 billion of total long-term debt that has now been pushed down to only $17.4 billion, so they've done a great job of reducing their leverage as the market environment has changed and interest rates have been going up. And now taking a look at their dividend, the company has a current dividend yield at 3.32%, they pay out $2.72 per share per year, a very safe and manageable payout ratio of only 48%, and a 5-year dividend CAGR at 8% overall. And this dividend growth streak is incorrect, like we saw from the investor presentation. The company's current dividend growth streak is at 45 consecutive years, making them a future dividend king. And if we take a look at their dividend safety score, they come in with the highest rating possible of a 99. Simply Safe Dividends ranks every dividend company, gives them a single-digit score to kind of gauge how safe their dividend is, and Medtronic right now, with the consistency of their business, with the types of products they sell that have sticky customers over the long term, a very safe balance sheet, the company has the highest dividend safety score possible, coming in at a 99, so I'm almost certain that over the next 5 years, this company will achieve a Dividend King status. So Medtronic was the first company worth taking a look at. They're considered to be undervalued by over 20% according to Morningstar, a very strong company that continues to return a ton of capital to their shareholders each and every year, and a soon-to-be Dividend King. So now we're going to continue on straight into the second stock in this episode, and that is ticker ADP for automatic data processing. This is one of the largest human resource management companies in the world, and they have one of the most popular payroll softwares on the market right now. They currently trade for $249 per share. They're up over 9% on the 1-year chart, and the company's a market cap just below $100 billion. They pay out a $5 dividend per share per year and a current yield of 2%. Over the long term, ADP has seen some incredible share price appreciation. On the 5-year chart, the share price has grown by over 122%. That doesn't even include the dividend. And if we take a look at the 10-year perspective, they're up more than 415% in just capital appreciation. So this company has done extremely well over the past decade. And what we just got news of is last week, the company announced a 20% increase to their dividend. So now per share per quarter is $1.25, equaling $5 per share over a 12-month span. And taking a look at the company's latest investor presentation, they are the leader in the human capital management market. They offer software products that come with very high margin, and they delivered payroll to over 40 million workers globally. They service 25 plus million in the United States alone, which is 1 in 6 US workers, and over 14 million workers outside the United States as well. They moved $2.7 trillion of US payroll in fiscal year 2022, and they service over 1 million clients in 140 countries. That's what I like to see with this business. They don't only have a few main customers driving them forward, they service over 1 million different clients on a global scale. During the past fiscal year, they also generated $16.5 billion of total revenue with adjusted EBIT of $3.9 billion. And again, their product mix and their different customer base is highly diversified across small, major, and international accounts. So they're not focused on one area of business in order to drive their revenue, which is a very strong sign. And taking a look over the next medium term, they gave targets at their last investor day. They're focused on revenue growth between 7 to 8% annually, adjusted EPS growth between 11 to 13%, and they believe they can buy back 1% of their outstanding shares each and every year, and they are targeting 13 to 15% total shareholder return, including the annual dividend of around 2% over every year for the next 3 to 5 years going forward, which is an absolutely incredible return on the market. And taking a look at ADP's outstanding share count, we can see over the long term they continuously buy back more and more stock quarter after quarter. Back in 2009, they had 506 million shares outstanding on the market, and as of the latest quarter, that has now fallen to only 417 million. So quarter after quarter, they continue to reward shareholders by buying back more stock, increasing total shareholder value. And taking a look at the company's financials, their revenue continues to expand year after year. Every single year, the top line has been growing to over $16.4 billion in the trailing 12 months, and their gross profit has continued to grow at a similar rate to the top line. If we go over the company's dividend, a forward yield of around 2%, a very safe and conservative payout ratio of 57.6% of their total net income, and a 5-year dividend CAGR of over 12%. And again, the dividend growth streak shown here on Seeking Alpha is incorrect. ADP's current dividend growth streak is at 47 consecutive years, so they're only 3 years away to becoming a dividend king. And currently their dividend safety score comes in at a 97. That is considered very safe, and it's extremely unlikely ADP cuts their dividend anytime soon. So overall, ADP was the second company we're taking a look at. It's currently a dividend aristocrat, very close to becoming a dividend king very soon. So that's stock number 2, and now we can continue on into stock number 3, the final name we're going to go over in this episode, and that is ticker APD for Air Products and Chemicals. So of course we just took a look at ADP, now we're switching around to APD. The company currently trades at $288 per share, and they're down just over 7% on the 1-year chart. They have a market cap at $62 billion, a forward PE ratio of 25.4, and a current dividend yield at 2.24%. Air Products and Chemicals is a company that many investors are not too familiar with, even though the company has very strong financial performance. I think due to the nature of their business, it's a chemical company. They also have gas and pipeline products. That's not very newsworthy. It's not very popular. Their business is very boring but consistent over the long term. And those are the companies that I personally like, and those are the companies that make great investments. So although APD is not commonly in the news, this company has had a very strong history of great financial performance. During the past year, they generated over $12.7 billion in total revenue. They've been in business for 80 years, they operate in 50 different countries, and have over 1,800 miles of industrial gas pipeline and service over 750 different product facilities. And ADP has done a great job of expanding globally. The company is diversified all across the globe, generating 41% of their sales from US and Canada, 4% from Latin America, 26% from Europe, the Middle East, and Africa, 18% from China, and 11% from the rest of Asia, excluding China. So overall, they are operating on a global scale, meaning if one geographical region has a slowdown, the entire ADP business is not shut down. And taking a look, they've done an incredible job of growing their annual EPS over the past 10 years. They have 11% CAGR in their earnings per share. So for a company that operates such a boring business, gas and chemical products, to grow their EPS by 11% is absolutely incredible. And taking a look at the dividend history, because we are all dividend investors, they have 40 consecutive years of dividend increases, and that annual payout to shareholders is growing at a CAGR of 10%, which is absolutely incredible. And the company is forecasting that going forward over the next 3 to 5 years, they will continue to increase their dividend at that high double-digit rate. If we take a look at the dividend yield right now, it comes in at 2.25%, a very safe and conservative payout ratio of 61% of their earnings, and a 5-year dividend CAGR at 11.4%, which is very fast and rapid, especially from a boring chemical company that's been in operation for over 80 consecutive years. So if we take a look overall, again, another very safe dividend coming in with a 95. So again, very certain this company will achieve the Dividend King status over the next decade. APD was the third and final company we were going to go over in this episode. So overall, we went over 3 companies who are soon to be future dividend kings. They all have dividend growth streaks of over 40 consecutive years. They all have a very safe dividend with a 95 plus dividend safety score. All have very strong fundamentals, sticky business models that lead to consistent revenue growth year after year. And overall, all 3 companies may make a nice addition to a dividend growth portfolio, and definitely worth doing some research into at this current point in time. So if you watched the video all the way to the end, I really appreciate it. Please hit that like button and subscribe down below, and I will see you in the next video.